Hello friends, today we're going to be diving into the topic of how does a lease option to buy a house work. So how does a lease option to buy a house work exactly? Well, by the end of this video, I'm going to help you fully grasp how a lease option can serve as a strategic tool in real estate, offering you a clear path to home ownership while at the same time safeguarding you as the buyer. So what sets a lease option apart from traditional renting or buying a home? How can it mitigate financial risks for all parties involved? So this is really an amazing strategy that I want to detail out by first diving in and explaining exactly what a lease option is. Secondly, I'll explain all the components and mechanics of a lease option. And finally, I'll explain how to structure a lease option that safeguards you as the buyer. If you're ready to jump in, let's go. So if you're looking to buy a home, how does a lease option to purchase really benefit you as the buyer? Now, one thing to keep in mind, a lease option is also called a rent to own. So it does a couple different things for you as the buyer. Number one, it gives you an opportunity to lock in the price of the home right from the get-go. Let's say that you're not quite ready to move forward and go out and purchase a home. Let's say you've got to get your financial house in order. Let's say that the bank needs more financials from you. Whether you're a business owner, you're self-employed, there could be a lot of things that say, I'm not quite ready to get a traditional loan. So here's an option. If I could rent that home that I want to buy, that I want to live in, that would be the best case scenario. And with a lease option, you can do exactly that. Matter of fact, it helps you negotiate the price up front of what you want to pay for the home, but not execute on buying that home until a period down the road, whether it's 12, 24, or 36 months. So that's what a lease option is, right? It's the ability for a buyer to go in and have the option to buy a home at a certain price at a certain date in the future. And same thing with the seller. He has the option to sell the home at a certain price at a certain date in the future. And as the buyer, another benefit is it gives you the ability to test drive that home right from the get-go. So you are renting the home that you plan to buy. What a great situation to be in, right? You can see if there's any major issues with the home. You can find out what the neighborhood is like, what the schools are like, how the neighbors are. If there's anything that stands out to you that you should not execute on this, all of those can be seen by living in the home that you plan to buy for a period of time. And as I mentioned, where you have time to actually execute on the home, there is an option price, right? So if you plan to buy this home at a certain date in the future, there's going to be a cost to do that, right? And it's typically between 2 to 7% of the purchase price. So looking in this scenario, let's say you found a home that you love. It costs $400,000. You negotiate it. You're going to pay $400,000 to buy that home 2 years down the road. But in order to have that option to do that, you've got to pay some money up front, typically 2 to 7%. So on the low end, you're looking at $8,000. On the high end, you're looking at $28,000. Now, the cool thing about that is that price you pay on the option can be counted towards your down payment of the home. So when you execute and buy the home 2 years from now, and let's say you've put $10,000 down, that can be counted towards your down payment. However, if you do not end up buying the home, that money is all lost, right? That goes towards the seller and you do not have any legal obligation or any legal way to get that back. That is all included in the lease option agreement. And another key component and a big benefit for you as the buyer is the monthly payment that you negotiate each month is the rent price. A portion of that or a percentage of that can be counted towards your down payment as well. So this home that you want to buy for $400,000, let's say that rent is $3,000. And you say, I want $300 of that to be included and counted towards my down payment. So 2 years from now, when you go and buy the home, you've paid $300 a month and that's accumulated towards your down payment over 24 months. That is $7,200. So if you put $10,000 down as the option price, plus you have $7,200 that's been accumulated over a 24-month period of time that's been part of your rent payment, that is $17,200 that would be counted towards your down payment. Let's say you get in with a bank who only requires you to put 5% down. 5% down on a $400,000 home is only $20,000. The difference you have to make up from the money you've accumulated through this strategy and the money that you have to pay as your down payment is only $2,800. How awesome is that? You've been able to live in the home that you've wanted to buy, and you've been able to utilize this strategy to accumulate enough money to cover almost your entire down payment. So when you execute on the home, there's very little additional money out of your pocket. It's an awesome scenario and an awesome strategy to engage in if you are the buyer. Now, part of these components and mechanics, it's worthwhile to look at what the seller looks at, right? So obviously we have the purchase price. We talked about that, negotiating that. The seller's obviously going to want a little bit more for the home. If they are selling the home right now for $400,000 and you're not going to buy it for 2 years down the road, depending on what the market is doing, they might want a little bit higher than $400,000. But that is all negotiated in this component of lease options of the purchase price. The second thing that the seller wants to look at is that option price. They're going to try and get as much as they want, but there's nothing anywhere that says it has to be between 2% and 7%. So it could be negotiated on the very low end, or it could be negotiated on the high end. But if you really plan to buy the home and you have the money to put down and you're serious about it, obviously as the buyer, I try and get as little as possible, but just know once you execute and exercise that option and buy the home, all of that option money you paid up front goes towards that down payment. And the other thing that benefits the seller that they look at this is they have a home that somebody is renting and paying a monthly lease payment every month to rent this home, and it's probably covering their mortgage and other expenses associated with the home. So they're in a good situation as well. They're happy about that. So now that we understand a lease option, what it is, the components on both the buyer and the seller side, I want to help you, if you're the buyer in this scenario, to safeguard yourself, right? So here's a couple of things that will do just that. Number one, we talked about is the price of the home. Now, obviously, if you're going out to purchase a home, you want to try and get that purchase price as low as possible, just like in any other scenario. If you're buying a home today and somebody's listing it for a certain price, depending on the market, you're going to offer a little bit lower than that. And this is the same thing with lease option. There's going to be some back and forth because, as I mentioned, with the seller, they're going to want to get a little bit more if they're not executing on the sale of that home for 2 years down the road. You know, there was a scenario that happened probably, about 3-4 years ago, where people were engaging in the strategy of lease options and they put an option to buy the home at a certain price, let's say $300,000. And that was the price of the home back then. But what did we see from the end of 2020 through maybe 2023 or mid 2022? We saw home prices really skyrocket and go up. So if somebody had a 2-year term on that and say it was the start of 2021 and they had an option to buy the home at $300,000, well, 2 years later, the price of that home probably went from $300,000 up to $400,000. So the sellers were kind of in a frenzy saying, I can't go through with this, but they were contractually obligated to do so. So there was a lot of lawsuits that happened, them trying to get out of the situation. But in the end, if it is locked up the right way, negotiating that purchase price up front is really important for you as the buyer, because if you're in an appreciating market, that's a great thing. Now, the inverse is also true. If you have it negotiated at a price and prices go down, you're still obligated to pay that price. But if the option money you paid is less than the difference between what the home is negotiated to close at and what the true value is right now, then it might be worth it to walk away. The second thing is the negotiating of that option price. As I mentioned, there is nothing in writing that says it has to be between 2% and 7% of the purchase price. So in our scenario and our example of a $400,000 home, do you have to pay $8,000 to lock up that home for 2 years and buy it 2 years from now? No, it could be 1%. It could be a few $1,000s. There's nothing that says you have to do that. So negotiating that as low as possible is really important. And when there's a lot of inventory on the market and homes aren't moving, your ability to negotiate that goes up tremendously. And the third component that will safeguard you as a buyer in this contract is the term of the loan. Now, obviously, you're not buying the home right now because you need some time to get your financial house in order, whether that's a job, whether it's self-employed, whether it's a business owner. And so you need to set the terms of the lease time as long as you need to in order to get your financial house in order. If you say, listen, 12 months from now, that's all I need to show that I can get this loan, I would extend it maybe 3 or 4 months just to make sure you have enough time. So also negotiating the length of the lease that benefits you the best is also a solid strategy to help you as the buyer. And the last piece of the pie is that monthly payment. So with the monthly payment, the more of that monthly payment that you can get counted towards your down payment is going to be crucial. So let's say it's a $3,000 payment and they want to give you 10%. If you could get up to 15% of that, $450, think about it. $150 additional dollars over the course of 2 years is an additional $3,600. So let's say that you're only going to get $300 every single month, and that's $7,200. But if you increased it up to $450, you're now looking at $10,800 that would be counted towards your down payment versus $7,200. That's a massive negotiating tool for you that could really help you when you close on the home. You might have to come out of your pocket zero money because it's already been accumulated through the option payment and the amount each month coming from the monthly payment counted towards your down payment. So these are a few things that will really safeguard you as a buyer Buy the option price as low as you can, the purchase price as low as you can, as much of the monthly payment as you can going towards your down payment every single month, and obviously the term of the lease that benefits you as the buyer. Now, these are some things that I've seen work really well to safeguard you as a buyer coming into a lease option, but I'd be interested in your feedback, so comment below. Let's engage in a dialogue, and as always, just for stopping by, I have a free gift. It's aaronsfreetraining.com. It is a short-term rental calculator. You put in the purchase price, the income, the expenses, and it does all the work for you and tells you whether it's a good deal or not. 100% free, no obligations. And once again, I appreciate you stopping by. Have an amazing day.